Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Guys, is the stock market really representative of the economy? We're going to show you the data that matters. Let's dive in.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you've not joined our service yet, come check us out, tradelikeagenius.com. Full service. You know, we have a chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening.
Okay, Bob. So we've discussed, the stock market, sometimes it gets detached from reality, and we pretty much agree that that's the case here. And you had an interesting chart that I thought ties into what I've always been hounding on, and that is jobs, jobs, jobs.
Yeah, it's interesting to me, Phil, is that everybody says the stock market is a predictive device. I think it's actually reactive. And the narrative's been like, hey, people have a job, they're going to spend money, the economy's good, stock market's going to rise. But, peeling back the onion a little bit, we're starting to see some fraying around the edges. If you want to throw this chart up, we're no longer a monolithic economy. Now it's really, depending what state you're in, how well you're doing. And it's really weird is that the redder you are politically, the more employment there is generally. And so there is a great chart beyond this one that's showing the states that are already starting to lift unemployment. And these are biggies. California's in trouble, Illinois is in trouble, i.e. Chicago, New York's in trouble. And really what's carrying the load right now is the Sun Belt. Texas, Florida, North Carolina, Virginia are really the bellwethers or the bell cows for employment. And this chart here shows that as a higher percentage of the states start reporting higher unemployment on their books, it creates a potential for a volatility risk, which is, if you guys remember Volmageddon, you get these 10, 18% corrections in the stock market within weeks. And I think we're at that point now where as the deterioration goes, it's more like, basically the ground is crumbling underneath, like being on an icy pond in April. You just don't know how thick the ice is. So I think we're at that point, as you know, and you've been preaching that they're going to try to blow this thing off so these guys can sell to you. And then we're going to get a pretty good pullback in the market. And I think this is one of the reasons why unemployment is starting to ratchet up in more and more places around the country.
Yeah, so we can go over a few metrics here real quick, wrap things up in terms of like what is signaling danger, what isn't signaling danger. So the first thing I thought we would do is we'd look at starting with initial claims, because that ties into unemployment somewhat. If you notice, we're at about 202,000. That isn't really danger zone. What is danger zone is when you start getting up into the 350,000s, then that starts to become an issue, and that's that line there. And you can see where when we intersect that line, you get these green shaded areas. Those are recessions. Those are US recessions. So one thing you can do is just slap a regular old RSI on the thing, and you'll notice where you kind of want to pay attention is when this thing starts to accelerate. And that's what I've circled here, is times where the RSI relative to the initial claims number starts to accelerate up, because that can be indicative that you're going into that window where initial claims is going to start to rise and precedes a recession. So we actually had that, remember in 2000, toward the end of 2022, we were seeing some things that were giving us pause as to maybe we were going to see a recession at the end of last year. Well, as you guys know, if you've been following the podcast, Yellen kind of trumped that with the injection of her own type of QE, which was just an really overdone issuance of T-bills, right? So that acted like a form of quantitative easing. So she kind of turned into her own Fed there, and it delayed things. But that's why inflation is sticky now, because you can't introduce a bunch of liquidity in the system without, if there's not a natural demand or expanding GDP, you're just going to create more inflation. So that's what we're seeing now, and that's why the CPI is sticky. But you'll notice that we aren't really ticking up yet. We're not seeing that acceleration here all the way to the left of the right of the chart here, and these numbers aren't in a spot spot where I would say, hey, recession's here. Now, let's check back in a month or two and see where this is at. If it starts to turn up, then I would say that we have an issue. If you're just basing it off of this, I would say maybe recession in Q3. So we'll see. The other thing we can look at is, we've shown this chart before. These yellow areas kind of show you where personal interest payments lead unemployment. So unemployment's this lower turquoise color, and we look for like rounded bottoms on these things, and we certainly have that here. Now, again, unemployment is not anywhere near where you would typically see, recession warnings. So that would require about 200 or 4.68% or somewhere around that level where you would start to get worried about, the economy really starting to go into a recession. Remember, the recession will be set in stone before these numbers. These numbers confirm. These numbers don't predict. But what does predict is personal interest payments. That historically has always led the unemployment, and we've had our biggest reading in personal interest payments here. So unless we're just going to defy physics here, we should have a very sharp rise in unemployment as the year progresses. Moving over to new orders. So this is new orders, manufacturing and non-manufacturing. So this is just combined. We dipped into it. That was where we had our warnings last year about possibly going into a recession. That was this area here, but you'll notice a reading of 48.5 generally is a big red flag. So we're not there, but if we start to dip back into that again, I would guess that probably would coincide with unemployment and initial claims also cranking up. And then that trifecta probably is going to give you a real good heads up that we're maybe a month or two out from an official declaration on recession. If we look at real GDP, again, we're not there. We dipped into it back in 2022. And that's why, again, we had several metrics that were saying, hey, brace for a recession in 2023. And then again, Yellen kind of trumped that. She's out of bullets, though. She can't do what she did in 2023 again in 2024. So, they're trying to time this with the election and all this stuff and keep this propped up. But post-election, guys, there's not a lot of incentive for these guys to do anything. They got to start paying the piper in terms of debt issuance and things like that. So they're out of bullets. So this is coming whether you like it or not, but we're not there yet. Okay. GDP is still in non-recession territory. Now, if we look at retail sales, this is a problem. Okay, and I think this is one of the metrics that's definitely screaming at you that we got issues, and we're a consumer economy, and we are in recession territory here on retail sales. So this is the one metric that in personal interest payments, I think, is screaming at us that things are not well, and these other metrics are probably going to catch up to these. And then finally, the yield curve inversion, which is the 10-year yield, the 2-year, and the 10-year. Now, we were racing up toward the white line, which is basically where we would say that the yield curve is now going back into normalization, right? It hits that white line is 0, and we no longer have an inverted yield curve. Well, again, Yellen has kind of deferred this from cranking up and steepening. But what's going to end up happening as you go into the recession trade, the front end of the curve is going to drop faster than the long end. So all yields will drop because there's going to be a flood into buying bonds, except that the 2-year will drop quicker than the 10-year. That's a bear steepener in terms of yields, and that's what's going to end up probably happening. And once we do that, once we cross that white line, we're not there yet, right? We're at minus 0.38%. Once we get to 0 and then positive yield curve, then you're going to start to see what's been projected in this blue line, which would be kind of the expected price action in the S&P 500. Right now, we've been bucking it. When you get the green zone, which is where the yield curve bottoms, so the yield curve bottomed in July, okay, and started to crank back up. That's when you kind of start to counter and gives you about 110 to 120 weeks, which takes us out to about October 2025. If the 2-year, 10-year is correct, that is how long you can expect the market to decline before it finds the bottom. And then from that point on, Q4, we can start moving up. And that's going to affect everything. That would affect stocks, crypto, all this meme coin stuff going on in crypto right now is we're getting in the final stages of euphoria. All of that stuff will be just ashes as you progress through something like this over the course of the next 12 to 18 months. So there you have it. Some of the data is nowhere near recession territory yet, but that changes quickly. It starts to accelerate. Some of this other data is telling us that we need to be very, very careful. I think the big one here would be the yield curve inversion, personal interest payments, and also retail sales. I think those are the big red flags that are leading indicators for the macroeconomic picture there, Bob.
Yeah, and the only thing I'll say, I'll add a political element to this is that first year of an administration, they tend to push the stock market down because they want to have it rising going into the next election. And if Biden wins the next election, they're going to go full on socialism, and you're just going to see headhunting against businesses. So I think a lot of these people, you're starting to see more and more wealthy people just go into cash here and cutting their portfolios down. And I think that realization is going to hit. My view is May 15th is not the top. Then we look at August 15th. That's not the top. We're definitely going to top before the election because I think people are going to be that afraid. Or right after the election is the November 15th look back of the quarter. Could be the come to Jesus moment too, because people might go, oh my gosh, we may have a Democrat sweep here. It's going to be awful for businesses. Let's cash out. But in the meantime, a lot of rich people are already going to be out, and it's going to be mom and pop. They're going to get their heads handed to them. So we're going to talk later this week about the signal that we're going to look at. Phil and I can live without getting any news whatsoever, and we have a pivot point that if you ignore it, you're going to get screwed. In the meantime, you can keep dancing. So with that, Phil, thanks for the recap, and we'll see you guys tomorrow. Check us out, tradelikeagenius.com. Humble brag time, we're actually changing some lives here to the good. So, want you to join us. Have a good one. Talk to you later. Bye.
Trade Genius.